There is a hedge fund that made 66% a year for 36 years, and you were never allowed to invest in it. The numbers on your screen are not stock prices. Not yet. They are distributions, residuals, proofs that almost hold but not quite. You are 23 years old, earning $52,000 a year, and you have never worked in finance. That is exactly why they want you. The firms that matter are not looking for traders. They are looking for pattern recognition under uncertainty. Level 1. The PhD student. The program runs 5 years, sometimes 6. Mathematics, statistics, physics, computer science, at a school where the name is a filter before you ever speak. MIT. Princeton, Stanford, Chicago, Caltech. The stipend covers rent if you share space, food if you stop optimizing your grocery list, and time if you treat it like capital. Your job is not to predict anything. Your job is to prove things. Theorems that exist whether anyone uses them or not. You teach undergraduates twice a week to keep the funding active. The real work happens alone, at the boundary between fields that do not fully agree on definitions. That boundary becomes your thesis. Year 2, a paper. Narrow, precise. It will be cited a dozen times. You will not track it. Year 3, you begin to see answers before you can justify them. The gap between knowing and proving becomes your entire environment. Year 4, a conference. 40 people in the room. Most are academics, a few are not. One of them approaches you after. He references your preprint without notes. He calls it interesting. You understand the tone. You email him that night. The first call comes 2 weeks later. They ask about noise that is not Gaussian. You say you have not studied it. You say yes anyway. You do not know the firm's name. You do not need to. You have passed a filter you did not know existed. Level 2, the junior quant researcher. The process takes 6 more calls, then an on-site. Probability questions that are not about answers, but about how you move when the answer is unclear. A derivation you have never seen. You get part of it. They measure the rest. The offer arrives 3 weeks later. Base salary, $175,000. Signing bonus, $75,000. Guaranteed bonus, $150,000. Total first-year compensation, $400,000. You check the number multiple times. It does not feel real because it has no context. You are 27. The office is quiet. No shouting, no screens flashing red and green, just people working. Your job is to find signals. A signal is a statistical pattern that predicts future price movement with an edge after costs. That definition sounds clean. The work is not. You spend months reading academic literature, annotating everything. Nobody asks you to. You do it because the annotations become your map of failure. Your first idea takes 3 weeks. It fails in 4 minutes. The portfolio manager says 1 word. Pass. No explanation. Your second idea takes 12 weeks. A small pattern around central bank announcements. The response. Interesting. That is enough. The signal goes live. You never see the P and L. You are not supposed to. At lunch one day, someone mentions a number casually. A signal written years ago has generated $300 million in cumulative alpha. The researcher who built it left. The signal did not. You do not sleep well that night. Level 3, the research scientist. You are 30. Compensation, $750,000. The number is real. You have stopped reacting to it. You own a strategy now. Not a single signal, but a framework. Dozens of signals interacting across multiple assets. You did not build all of them. Some were inherited. You test them, break them, rebuild them. The work feels less like invention and more like archaeology. The central problem is capacity. Your best signal works until it doesn't. At a certain scale, it begins to move the market itself. The edge degrades. You spend months building something that cannot be deployed at the size the firm requires. You present this. The response is a nod. You start again. The hours are manageable. The pressure is not. Entire months pass where nothing works. Then one idea survives. That is enough to justify the cycle. You write internal papers no one outside the firm will ever read. A recruiter calls. Portfolio manager role. You ask for time. You are not ready. You know exactly why. Level 4. The senior researcher. You are 33. Compensation $1.3 million. Your signals run across multiple strategies. You understand how they interact. Which ones are fragile? Which ones depend on conditions that can change overnight? The NDA conversation happens again. Not onboarding paperwork. A reinforcement. Everything you build belongs to the firm. If you leave it behind. Not just the code, the thinking. You sign without hesitation. The insight at this level is simple, but difficult to replicate. The edge is not in any single signal. It is in the combination, correlation structures, portfolio construction, how signals behave together across regimes. That layer is not written down in one place. It exists across people, systems, time. You are invited into conversations about it. You understand enough to see how incomplete your understanding still is. Then the offer comes. Your own book. Your own capital. 10% of profits. You ask for a week. You build the risk framework you would trust under stress. Not the signals. The structure. You cannot find a flaw. You accept. Level 5. The portfolio manager. You are 36. You run $800 million. Base salary $200,000. Irrelevant. Performance is everything. A good year returns 15%. That is $120 million in P&L. Your share is 8 figures. A bad year returns nothing. You are right slightly more than half the time. That is enough. The rest is controlled loss. You lose $30 million in 9 days when a volatility regime shifts faster than your model adapts. The reaction is procedural. Reduce exposure. Recalculate assumptions. Continue. There is no external validation. No feedback beyond the numbers. The market is the only evaluator. The isolation is total. Your system works. It survives stress. It produces consistent returns. It is real. Then you hear the number again. 66% annual returns. Decades. No outside capital. The medallion fund. You already knew it. What you did not expect is the reaction. There is none. No disbelief, no urgency. The number is accepted. Like gravity. Like a constant. Something that exists whether or not it is explained. You sit with it. Because your system works. But it is not that system. The final turn is not a revelation. It is an adjustment. The medallion fund is not one model. It is thousands. Signals built, tested, replaced, combined. A system that evolves faster than individuals inside it. Researchers leave. Signals remain. The architecture persists. The fund is closed because scale would destroy it. The incentives are aligned because everyone inside is invested. The edge is protected because it cannot be extracted in pieces. There is no paper, no presentation, no explanation. You return to your desk. Your models are running. The positions are updating. Your system is real. The returns are real. The work is real. It is also not the best system. It never was. And you understand something clearly now. You were never competing with them. The race ended before you knew where the starting line was. You go back to work.